A rough week in the markets as nobody's really happy with the direction of the Fed these days. As a result of that, we retested the June lows in all major markets. So what's the opportunity and how do we play this from here? Welcome to the 12-Minute Trading Market Minute for Sunday, the 25th of September. We'll start off with the daily chart on the S&P 500. Before I get into the actual technical studies and their values and how deeply oversold we are or how exhausted we are, I want to look at the structure of the price action first. This to me is the most important thing. This is the most top-down thing that we can do, which is more strategic versus tactical. What I have found is in studying bear markets of the past, they usually go through three phases. The first phase is where we change the trend and get more volatile to the downside and establish a change from those quiet and trending and linear markets to the upside into what is much more chaotic, much more nonlinear markets to the downside. So we don't see these that often, so it's very important that we recognize them when they do show up. Now, to me, these come in three phases. The first phase we've already gone through, and this establishes the fact that we're in a bear. And usually we go somewhere between 20 to 25% to the downside, and we can already check this box off. The second phase is a required rally back up to make everybody believe that all is over. And as you can see, we retraced a little bit more than 50% of this initial bear move. This is phase two, and phase two is necessary to trap more longs to make everybody believe, okay, this is it, it's all over. And we can check that box as well too. We've already gone into phase two and finished phase two. Phase three is the worst of the bunch. Phase three is where we can go much, much lower. And again, where this ends up, I'm not necessarily that interested in right now, because I think it's a fool's errand to try to predict where price is going to be going forward in the future. We don't know how the market is going to de-risk itself going forward. We don't know what steps the Fed is going to make. If they finally realize, oops, I think we've gone a little bit too far, a little bit too fast, and maybe we should back it down a little bit. Or is that going to generate more uncertainty if they do that? So guys, I would say there's a very real possibility that we are just now starting phase three to the downside. And the fact that we have already come down to retest those lows means that that is started. Now, anything can happen from here. We could rally up like crazy from this point. The Fed could come to their senses on Monday and say, you know, guys, we're just kidding. No harm, no foul. All is forgiven. We're going to slow down these interest rate hikes. And we were just kidding when we said that we would crash the economy and cause pain to everybody out there. So I think this would be well received, although I think this would create more uncertainty down the road. But for right now, this would certainly create a massive rally. But I doubt that that's going to happen. I think the Fed is going to double down. I think they're going to become even more stubborn that they have, because they have a huge credibility issue right now with this whole notion of transitory inflation last year. And so they're trying to reclaim that simply by sticking to their guns. And time will tell. I think history will be not so kind to this administration of Federal Reserve. So now that we're in the third phase of the bear, this is where things can get to be really tricky, because quite honestly, I think that we can throw a lot of our technical analysis out of the window. What is oversold can become much more oversold. And we're going to see this again and again going forward. However, there's no reason why we can't look at things on a swing by swing basis and understand when things have gone a little too far, a little too fast, and we might start to anticipate some counter trend rallies in here. We certainly will get counter trend rallies along the way. For that, let's go back in time and let's see how the last two bears handled it. So I think that we're right around here as we're comparing to the 2008, you can see that we had a little bit more left to go. And then we had a couple of months of rally up here, very choppy. This is just a bear flag though. And then the worst of it really began at this point. But you'll notice that in each case, we did have a very strong counter trend rally coming back up each time. Each time we set up this way, and then the very final end, and then a very strong counter trend rally, which finally broke the trend line, got the price above the 200-day moving average, which is very important. It's about the only time I think it's important, this moving average. And when we compare the 2007 to 2009 bear versus the one that preceded it back in 2000 to 2003, this one took a lot longer. This was really brutal because we had almost decades of excess to wring out. And so you can see this is the initial 20% move. We had that monthly lower high set up. Here was the transition into phase 3, and this one took a long time. Look at the size of the rallies that came up, all of them below the 200-day moving average. Part of this was due to 9/11, but very strong rally back up, failed at the 200 once again, and set up a major lower high in the monthly chart once again. Price did get above the 200 shortly, or just temporarily, before the worst of the selling comes in. The worst of the selling is always at the very bottom of these bears. And then we had a very rare thing, which is a triple bottom. And this took the better part of a year to work itself out. So this has the same type of signature in a way that 2008 did. We had the initial bear move into 20%. That's phase 1. We did have a good size rally up to a monthly lower high. That's phase 2. That's necessary to give everybody the illusion that everything is better. Everything is going to get fixed. And then this is where they all get thrown overboard and constantly thrown overboard. So this is why bear markets can be very, very tricky, because you don't know which one of these is the real one. There was a huge amount of skepticism, obviously, in this rally in early 2003, like, oh, I'm not going to jump on that one. It's just going to disappoint me once again. And typically the real rally that comes off the bottom, nobody is on board. I'll put a big 0 there. Nobody's on board for this one except the smartest of the smart money. So with that in mind, what can we learn from looking at today? Well, we're going to look at some of the values that are showing in the price action today. But once again, I would say that we may be just at the very beginning of the third phase of this bear. And this is not the worst selling that we're going to see. We have seen nothing that reminds me of capitulation in this type of market yet. With that being said, I think we will see short-term bottoms. I think we will see strong rallies, very similar to what we saw back here in July and August. And it will just kind of continue until we eventually close above this descending trend line, which you can see up here. Descending patterns will eventually break to the upside and will eventually close above the 200-day moving average, which will be one version of determining whether this thing is over or not. We'll cross that bridge when we get to it. So from here, I'm going to look at a couple of studies that help us become objective in understanding what's happening below the hood of the market. And one of them is the choppiness index, what we call the fractal energy indicator. And it shows the linearity of any specific swing or trend. This is a 14-day sample. So if we count back here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So couple of things here. First of all, when this indicator gets down to 25, I never see markets go much further. This is usually like a huge red light. And so what this does show is a very low value shows that we have a very, very linear move. Linear moves like this, straight line moves, like the one that we had back here into the end of August and early September. These take a tremendous amount of energy out of the market. It's very difficult to keep the price moving in one direction for any length of time. And so what's going to happen is over the next 4 days, we're going to lose these candles off the back end, which is keeping it from being absolutely exhausted. So we're going to lose these as part of the sample, and we're just going to be left by the end of this week with an extremely linear move. So what I found is that when markets get down to about 25, they do not move any further. Technically, this is in exhaustion right now at a value of 32. But starting on Monday, this will be even lower because these will start to drop off the back end of it. And we're going to be left with a trend that you can almost stick a ruler on. You can see this even here. Some of the worst selling we've seen in decades didn't last for more than just a few days before we got a counter trend reaction back to it. And that ultimately spawned a 2-month rally back up to the upside. Notice where it died right at the 200-day moving average. So how do I view this? I would say if there's any further downside into early this week, coming up on Monday, Tuesday, it's going to be very, very limited before we're going to see a snapback rally, even if it's just for a few days, even if it's just to create the next bear flag. We should see a reaction sometime by mid to late week of this week coming up. The next study I'm putting up here is called the Mcclellan Oscillator. The Mcclellan Oscillator. This is a really, really old school oscillator that I don't see a whole lot of people using anymore. Just the real old school pros that have looked at stocks. This is one of the first oscillators that they use to determine whether something is really overdone and may present some opportunity. And really, if we see values that are below 350, negative 350, and right now we're sitting at negative 376, and this will get even worse as we get into Monday. And if we compare that versus previous scenarios back here, we had at the pandemic, we had almost negative 415, very, very unusual move. And you can see this was so strong and so short that it created a massive slingshot move back up to the upside. But even if we get to the end of 2018, this was a negative 337. So we're already worse than that right now. And let's compare this versus the actual last two bear markets. The worst reading that we had during the October 2008 timeframe was negative 394. We're almost there and probably will be there by Monday. And then if we, unfortunately, I can't seem to go beyond 2006 for this data. So I'll have to look for this under TradingView or some other platform and see if it has it. But that's really, if we look at the last 13 years, we are at the very edge of some of the worst moves that we've seen. 2010 back here during the flash crash, this did create a negative 434. So we've seen worse numbers in the last 15 years, but very, very few of them. Here is the 2011 crash that was instigated by Standard & Poor's that got down to negative 444. Very, very quick move. And you can see that we never did get much more downside than that. Okay, so we are just about there. This is an extreme move that we've seen over the last 2 weeks. Since this was the CPI move, this is the CPI reversal move, and then we made it worse with this past week's Fed meeting, applying more uncertainty to today's markets. Now, you might say, how can we take advantage of something like this? Well, the most obvious way to me is when we get extreme values like this, we can sell puts a decent distance out of the way, or we can actually get very, very aggressive by selling cash secured puts. And then as the price rebounds, we're going to have two things helping us. As the price rebounds, wherever that is, we're going to have two things helping us. First of all, a cash secured put is going to be long delta. So I'll just put long delta here. So as the price goes higher, our option becomes less and less valuable. If we sold it to open, it becomes cheaper to buy it back and close the trade out, meaning more profitable. And also what happens is the implied volatility tends to drop for that. So we have two factors accelerating profits in there. So the best way to take advantage of these is identify assets that you're okay being assigned to, and then sell cash secured puts, but don't hold on to it for too long. Don't fall in love with that investment. Don't get greedy. Just look for a quick pop to the upside, a quick volatility crush, a nice delta move in your direction, take profits, and then move on. This is one way to make money on extreme markets in the bear. And then, of course, once we're up at a reasonable reaction point and the implied volatility drops, then it becomes cheaper to buy trades with a downside bias to them. You don't want to ever chase after downside trades when the price is already released. You got to be in it to win it. You have to be very, very contrarian on your entries to the downside. This is, again, why the bear is so difficult on so many traders. All right, that is it for today's Market Minute. Thanks for listening. I know this was a long one, but there's a lot of uncertainty out there. I hope this gives you some kind of sense of market structure going forward. We'll see you in the next Market Minute.